Hey, it's Rob Minton and welcome back to another Cash in Our video. In this video, I want to talk about how you can make better, more profitable real estate investments by reducing your risk. I don't know why I'm doing this, but this, I think, means reducing your risk. Early in the morning, I'm a little slap happy. I guess I should just start by saying, when I first started to invest in real estate, I did not think much about risk. It was the early 1990s. I just thought that, hey, real estate historically increases in value. So if I invest in real estate, that my properties will increase in value over time. Over the long term, that's probably an accurate description. And real estate obviously kind of kicks up a couple of notches in terms of appreciation during periods of high inflation like we're experiencing now. But because of my lack of experience back then, I didn't really have any understanding of what could possibly go wrong. Sitting here today, I certainly have a lot more experience and I've been through numerous problems, so I have an idea of what can go wrong with rental real estate and investing in real estate, which leads me to this video. So the key thing to kind of understand when you're investing in real estate is the market cycle you are in at the time. So if you are in a seller's market, which in Northeast Ohio, as I'm recording this video, we are in a seller's market. And a seller's market means there are fewer properties on the market, there's low inventory, and there are lots and lots of buyers. So there's more buyer demand than there are properties, which means sellers command the market. They control the pricing, they control the terms. Buyers have to pay more money to buy homes today. On the flip side, a buyer's market is the exact opposite, meaning there are lots and lots of sellers on the market, fewer number of buyers, which means buyers control the market. They can negotiate favorable terms, lower price points, and real estate is like all other markets. Like the stock market goes through cycles, right? So same thing with real estate. Right now we're in a seller's market. At some point in the future, it might flip over to a buyer's market. And obviously, if you're going to invest in a seller's market, there is more risk. And that's simply because of the supply and demand function that's operating during that market cycle. So if you are in a seller's market and you are going to invest, you have to be very careful. You have to do things to reduce your risk simply because of the supply and demand situation, right? Sellers call the shots in a seller's market. So you have to be very strategic to make sure that you make profitable investments and that you reduce your risk in this particular market. All right, so let's dive into some risk reduction strategies. And I'm going to tell you right up front that I'm going to have trouble articulating what I mean by these strategies. And I know that sounds kind of weird. Hey, Rob, you're going to record a video about something that you can't even express in words? Yes, that's exactly what I'm doing. And I think the reason why it's hard for me to describe it is because these ideas come from experience, and it's not like something you're going to find in a textbook. Kind of learn this stuff over time. And the first strategy is that you cannot do what everyone else is doing. So if you're going to invest in real estate and you're going to just go out and buy a rental property and offer it for rent, you're not going to probably have great results, especially in a seller's market. And that is simply because you have no edge, you have no advantage. So if you're going to go do what everyone else does, you're going to get the same results that everyone else gets. And you can't make great investments if you get the same results that everyone else gets. You must use different rental strategies or cash flow strategies with your investments in today's market to reduce your risk. So this leads me to the second strategy that you can use to reduce your risk. And it's kind of connected to the first strategy, but this strategy is that you cannot pay full value for a property. And please notice that I did not say full market value. When most people hear value, they think market value. And as an investor, the property should have a different value to you than it should a regular buyer. So a regular buyer looks at a home, let's say it's a $200,000 home. They want to buy it below market value. So that might be 180, 190. And certainly it's helpful to buy below market value. But if you're an investor and you have different strategies available to you that you can use to extract more income or more value out of that property has a different value to you than it does to the typical buyer or the typical investor for that matter. This, like I said, connects to step number one, right? So you have to do things differently that allow you to extract more money from the property. The key strategy to do that is you have to be able to increase the demand of the property. I just said that the market cycles kind of dictate where things are. So wherever the demand is, that's where the money's at. So as an investor, you have to be able to increase the demand for your property. That allows you to increase the value and the cash flow. And I think I do a much better job of describing this opportunity with examples in my free class, where I show you how you can multiply real estate assets, how you can expand one investment into a large portfolio of income producing assets. And that class is available to you for free. It's either going to be in the description or in a pinned comment. That class includes 30 years of experience in the trenches, and I really do share some powerful strategies that you can use and opportunities that most people don't see. I show you where the real money is in real estate, which is critically important for you to understand to make great investments. So please register for that class and understand that just because it's free does not mean that it's low quality. I'm telling you, if you watch that class and take notes, it will allow you to make more money with your investments. This leads me to the third way that you can reduce your risk, and that is to always invest into demand. That means that you must know exactly what your numbers are going to be on a property before you buy it. You must know that your investment is going to be profitable before you even make an offer. I mean, that's what I mean by this. An easy example is, let's say you buy this $200,000 home, and you know, because you can study market demand, that you can rent that home very, very easily for, say, let's just say $2,000. So you know, you buy the home, pay $200,000 at closing, you can put a for rent sign out, and it'll be very easy for you to rent it for $2,000. You know your numbers, right? So you know what the taxes, insurance are, you know what your income's going to be, you know that in advance. And that makes sense, right? You're like, oh, yeah, I would always want to invest in demand. But the problem is demand changes, right? So if demand changes, the profitable investment that you thought you made becomes not so profitable. And I've talked about this in a different video, which I will include in the description below. But this then means you need to buy a property that will always be in demand going forward. And a great example that I like to share with this is commercial real estate. Over my 30 years of investing in real estate, I've had numerous problems with commercial real estate. The first commercial property I owned had several little storefronts, and when a storefront would go vacant, we had the hardest time renting it. And that is because the demand for commercial properties in that particular area was very low. And then I bought a commercial property for my building, my real estate company, an 8,000 square foot building. And when the market crashed, I sold the business, and the buyer moved out of the space. There was zero demand. So for me, commercial real estate is incredibly risky, and that's simply because I'm unable to gauge the long-term demand. For some people in different areas, commercial real estate is an awesome investment, and that's because there's a ton of demand. But for me, it's off the table. I won't even consider it. I'm reminded of this every single day, close to my home. On my way, usually I'll run by this place. We live close to Lake Erie, and there's this commercial property that used to be this amazing little grocery store, you know, the type of store you could walk to and get milk and eggs and whatever. But sadly, this place went out of business a long time ago. And some poor fella bought this property as an investment, and he has been struggling ever since. It was vacant for a long time. Then he started like a secondhand store or a consignment shop, and he's tried everything possible, but it's sitting vacant again. So no demand, bad investment. No ability to assess long-term demand means it's a very, very risky investment, and it's really not worth your time. Risk reduction strategy number 4. I think I'm number 4. I get messed up in my numbers in these videos, but that strategy is to buy properties that need work. And I know you don't want to hear that, right? It's like, oh, I don't want to buy a fixer-upper. Well, if you are in a seller's market, you may have to buy a fixer-upper. And the reason why fixer-uppers potentially are better investments for you is because there is less buyer demand. There's less competition for you to buy that property, which means you should be able to buy it at a lower price. You can then fix the property up and use whatever strategy you're going to use with it to extract more cash flow and increase the value of the property. So I'm going to show a video of me walking through one of my manufactured home investments. Now, this particular home I've owned for a long time. The family had moved out and they had trashed the place, and it's in bad shape. But this is basically the type of property that I'll buy. I'll buy a property that needs a lot of work, then I'll fix it up, and that's how I add this margin of safety with my investment. I obviously know the demand for this property, so I know I'm making a profitable investment before I even buy the home. You could see here in the video that this home needs a lot of work. It needs flooring, it needs paint, it needed a new bathtub, it needed a lot of work. But this is the type of home that offers a great deal of profit. If you want to make profitable investments, you need to get to the point where you're able to buy properties that other people won't buy. It gives you an advantage, it gives you an edge. Now, to show you kind of what we did with that property, I'm going to include another video for you here, which shows you kind of the end result of that property. You can see here that it's been painted and cleaned, obviously, and new flooring has been installed. This room here is a bedroom that was added. So this is a single wide home, but prior to my ownership, someone added a bedroom. This room was a wreck because there was a roof leak, so that's all been fixed. But the room adds a ton of space, makes it feel much larger. Still some work to do, but the flooring's in it, looks so much better. We'll go down the hallway. Here's a second bedroom, smaller bedroom, but has a nice clean look feel to it. Here is a third bedroom and another small bedroom. These manufactured homes have smaller bedrooms, single wides do these. Here's the laundry area, the washer and dryer go there. And then here is the fourth bedroom. It's the largest. It would be the primary bedroom, except for this one has that addition. And then here is the bathroom. And I apologize if the power is off. This tub, even though it doesn't look like it, it's a new tub and a new surround. The prior tub was cracked. I had to drive to Erie, PA to buy this tub because the mobile home tubs are a little bit smaller. There's some gloves and stuff soaking in there to clean, but the bathroom has kind of been rebuilt. So this is, you know, a manufactured home. It's a great starter home for somebody, especially in today's market. It's probably the most affordable way to buy your own home and own your own home. And so that's the video. The fifth way that you can reduce your risk is to be very strategic with your use of debt. I've talked a lot about debt in prior videos in my books, so I'm not going to go too far into this strategy, but obviously, if you leverage every single property you buy to the max, you are taking on more risk. This risk obviously fluctuates depending on market cycles, so you have to be very careful with debt, especially in a seller's market, right? Because if you buy a property for full value in a seller's market and the market shifts and prices drop and you have debt on that property, you're going to be in a negative equity situation. You're going to owe more on the property than it's worth, which is a challenging situation to be in. So my suggestion is to be very cautious and strategic with debt. And in fact, I would recommend that you use strategies to pay down mortgages as quickly as possible. And I've shared a really cool strategy that you can use in a different video, which I will try to remember to include below, but you want to be very strategic with how you manage your debt, and that will help you reduce your risk significantly. Last, and certainly not least, is the sixth strategy to reducing your risk, and that strategy is to always have a backup plan. So you might be interested in buying a property to use one strategy with it, but you need to think through what would happen if that strategy does not work for you. If that strategy doesn't work, what is plan B? When I started to invest in real estate, I didn't really have a plan B, and that's because I didn't understand the risks involved. So a great example of having a backup plan is, let's say you want to buy a fixer-upper, fix it up and resell it. So you buy the fixer-upper, you invest all this money to renovate it, and then the market shifts and you cannot sell it for the price you were thinking you could sell it for. So what is your backup plan? So you need to have a backup plan that will be profitable for you if the primary plan is not available to you. So you want to make sure that you're going to make money on that property regardless, and the only way to do that is to have a backup plan before you buy the property. All right, so I have covered a lot in this video, but once again, I do a much better job of showing you how to make profitable investments in this free course on how you can multiply your real estate assets. You can get it below. Please, because it's free, don't discount it. There are some really cool strategies that will allow you to make more money with your real estate investments. All right, that's it. I hope you took some value out of this video, and I will catch you in the next one.